In a surprise move, the government has appointed Sanjay Mehrotra as the 26th governor of the Reserve Bank of India, succeeding Shaktikanta Das, whose 6-year term ends today. The announcement came just hours before Das's tenure concluded, as Mehrotra takes on one of India's most influential roles. At 56, Mehrotra, an IAS officer from the 1990 batch, is set to serve a 3-year term starting December 11th. Known for his meticulous approach and detailed insights, Mehrotra has been instrumental in handling budget proposals and preparing for the upcoming GST Council meeting. A graduate of IIT Kanpur and Princeton University, Mehrotra has extensive experience in financial services, having previously served as Secretary of Department of Financial Services and as a government nominee on the RBI Central Board. His appointment highlights a preference for civil servant leadership, continuing the trend set by Das and indicating continued coordination between the centre and the RBI. Mehrotra's appointment marks him as the third IITian to head the RBI and the second to do so, following R.N. Mehrotra, who led from 1985 to 1990. Shifting focus to global news, China now plans to adopt a more relaxed monetary policy in 2025, its first such shift since 2010, aiming to revitalize its slowing economy. Now, state media reports that the Politburo has committed to unconventional fiscal measures and strong counter-cyclical adjustments with a strong focus on boosting domestic demand and consumption. For China, this signals a strategic pivot to counter global economic pressures. Although for India, it could mean increased competition in global markets, especially as China seeks to ramp up exports. On the flip side, India may benefit from lower commodity prices as China prioritizes internal consumption over large-scale industrial output. In a major move, market regulator SEBI has issued a cautionary note for investors, urging them to steer clear of electronic platforms and websites that facilitate transactions in unlisted securities of public limited companies. These platforms operate outside SEBI's regulatory framework, making an interaction with them a breach of its rules. SEBI emphasized that such platforms lack authorization or recognition, warning investors not to conduct transactions or share sensitive personal information on these websites. This serves as a reminder for investors to stay vigilant and ensure they engage only with regulated and legitimate avenues for their investments. Now, Syrians awoke on December 10th to a mix of hope and uncertainty after rebel forces seized the capital Damascus and President Bashar al-Assad fled to Russia, ending 13 years of civil war and over 50 years of his family's authoritarian rule. A swift and decisive campaign by Syrian rebels in recent weeks led to a rapid collapse of government forces, prompting Assad and his family to leave the country. The dramatic turn of events sparked celebrations across Syria, though many residents remained wary about what the future would hold for them. The rebel victory had given residents hope that after over a decade of conflict, the nation might finally move towards stability and normalcy. Now, considering the ongoing tensions in the Middle East, oil prices, they jumped by over 1% as Syria's political upheaval added uncertainty to already volatile Middle East. Brent crude is trading near $72 a barrel, while US crude stands at about $68 per barrel. Meanwhile, the Indian rupee has hit a fresh low of 84.9 against the US dollar in non-deliverable forwards market, signaling concerns over a potential shift in RBI's currency intervention strategy under the new governor. In a noteworthy development, the government may discontinue sovereign gold bonds or SGBs starting financial year 26, citing a focus on reducing debt. This could impact gold demand and alter investment dynamics, especially during India's festive season when gold sees peak interest. Alright, we have a very special guest joining us on the broadcast, Nishchal Maheshwari, who is an independent market analyst. Now, sir, I want to begin by asking, about this news that we are getting there. There are reports that the government may, in fact, discontinue SGBs. How could the discontinuation of SGBs influence gold prices and investment patterns in India, especially for the small investors out there?
So, morning, Suresh. I've not seen this news, but I think when the SGDs were bought in, basically, it was largely to cater to the investment demand in gold. So I think that is going to take a bit of a backseat, especially for the small investor. Larger investors obviously have got international exposures, and they can actually go out and buy larger quantities of gold in physical. So definitely, I think this is going to be a bit of a setback for the smaller investors.
Well, the RBI has also appointed a new governor. Sanjay Malhotra is set to take, the seat or the helm of RBI starting December 11th. Now, he is up against a trilemma: boosting growth, controlling inflation, and stabilizing the rupee against the dollar. In your view, which of these will be his toughest challenge and why?
I think the toughest challenge would be stabilizing the rupee, because the other two things, I think one is already the inflation is already on the downward, and largely the inflation is led by the vegetable prices. So I think post this November or December, basically, as the earlier governor had said that he expects inflation to come down in starting next quarter. I also believe so. The international situation just continues to remain very volatile. You have a new president joining in the US, and that's why I think the dollar has been very, very strong. And then you have a volatile Middle East. So I think these are two things basically which are not in the control of the governor, and that directly influences the rupee. So I think that will be the biggest challenge for him.
All right, let's also look at some of the global trends that are coming in and how that could influence the stock markets here in India today. Now, Chinese stocks, they rallied on Tuesday, fueled by optimism across the region after Beijing announced plans to for rate cuts and measures to boost consumption. Now, the Shanghai Composite surged by about 1.5%, while Hong Kong's Hang Seng gained 1%. This optimism spilled over to the MSCI Asia Pacific Index, which climbed about 0.3%, and Japan's Nikkei, which added about 0.4%. The move supports commodities and currencies like the Australian dollar, but global markets remain cautious ahead of key US inflation data. Speaking of US markets closed in the red on Monday, weighed down by a sharp drop in Nvidia share prices. The Dow fell over 0.5%, while the S&P 500 and the tech-heavy Nasdaq both declined by about 0.6% each. Nvidia said slid 2.5% after China's antitrust regulator launched an investigation, sparking concerns across the tech sector. Other chip makers felt the heat too, with AMD tumbling 5.5% following a downgrade by BofA Global Research. Meanwhile, Oracle saw a 7.5% drop in extended trading after missing revenue expectations, and Comcast lost 9.5% on weaker broadband subscriber forecast. All right, Nishal, we are seeing some bit of a bullishness in Asian markets. The markets over here are yet to open. Especially China is what's driving the sentiment as far as Asia is concerned. Do you think Indian markets will benefit from this, from a positive rub-off effect? Also, the US markets are facing some bit of a volatility ahead of the upcoming inflation data. What impact could that have on Indian markets?
So I think Indian markets are on an even keel basically at the moment. I do not see much reason to feel worried about it. As we were talking earlier, I think the inflation seems to be okay. I believe there is going to be a first rate cut, which is most likely to be in February. So I do not see much reasons to worry on the Indian side. The only worrying point is the demand. As more and more FMCG companies are coming out and saying basically that the demand is not reviving at the rural as well as the urban level. So that is a more worrying feature basically. So, but one of the reasons which I've been able to figure it out is basically that in the last 6 months, given that there were so many elections and general election was there, government spending has come down dramatically. And as we see government restarting that spending, we start seeing very, very large orders coming out basically on the infra side. So I think that should spur the economy again and the consumption again. So not much to worry about as far as India is concerned. Globally, yes, inflation data is to be looked very closely in the US. But I think another rate cut is definitely on the cards in US in December.
Right, let's shift focus to Indian markets because they are about to open in just a couple of minutes from now. Now, after a strong rally since mid-November, Indian markets have seen some selling pressure over the last couple of days. The Nifty has climbed almost 1400 points or about 6% since November 21, but it's now facing resistance around the 24,700 level, which has in fact resulted in a 2-day selling streak. However, the broader markets are holding up well. Both mid-cap and small-cap stocks have continued their positive run with modest gains yesterday. In fact, these indices have gained around 10% and 11.5% respectively over the past 12 sessions. On the investment front, foreign institutional investors or FIIs have been net buyers in the cash market, pouring in over 25,000 crore rupees into the Indian stocks this month alone after pulling out funds in the last couple of months. Meanwhile, domestic institutional investors, which remember have been providing constant support during the the sell-off that we were witnessing from FIIs, were offloading shares yesterday. They have offloaded shares of to the tune of about 1600. Now, GIFT Nifty is also indicating a sort of a flattish to negative start on December 10th. Tracking cues on GIFT Nifty, that's trading about 24,717, down by about 0.05%, so a flattish start, and this trend is as of 8:45 a.m. this morning. Nishal, I'll come to you over here. Now, very interesting thing happened yesterday. I mean, in fact, if you look at the month of December, FIIs, they have returned back with strong buying, but domestic institutional investors, at least yesterday, they were selling. They have been pretty much providing support to the market in this correction that we had seen in the previous 2 months. But what could be the reason behind this shift in strategy? Should this be something retail investors should be worried about?
I don't think so. These are all temporary things basically. Nifty is in a broader range of 24,700 and the upper side, and 23,800 on the downside. So I think 1,000 point is a good number basically for anybody to trade. So I think most of these institutions, especially domestic ones, must be booking some amount of profits. And again, this is the end of the year internationally. So I think as you approach closer to December end, you will see activity dropping basically, and people who have people generally go out on leaves and all. So activity will definitely drop, and levels of interest will go down. But I think the yesterday selling is largely profit taking. I don't see any other reason for them to change any strategy, and I don't think so they have changed any strategy.
Nishal, I'll just push in one question before the market opens. While the broader markets, they have, the headliners, they have been witnessing some selling pressure in the past couple of days. The broader markets, they seem to be doing pretty well. In fact, they are on a 12-day winning streak. Both mid-cap and small-cap indices have rallied by about 10 to 11.5% in the last, since mid-November. And that has really helped the breadth of the market. Even when the market was falling, the overall sentiment, or at least the advance and decline ratio, which indicates how many stocks are rising compared to how many are falling, that was in the favor of bulls. What's your view on the broader markets? Will this rally continue as we had seen in the past 12-15 months?
So I think there has been a bit of disappointment in the second quarter of earnings basically, and that's why you've seen this kind of a sell-off which happened in the Indian markets. Now we have to wait because I think there are still some worrying signs on the horizon because demand doesn't seem to be reviving as most of the FMCG companies and consumption companies are talking about. So I think that is a worry. But as I was telling you earlier, as the government comes back and starts spending again, that should give a support to the earnings momentum. But I think the quarter three would be a bit subdued, and you would see a revival again in the quarter four as far as earnings is concerned. So market is waiting for a clear direction, and that's why you're not seeing a much broader rally or a much sharper rally from here. But I think market is anticipating this government spending and the revival to happen. and inflation to fall. So that's why I think markets are in a more of a trading zone at the moment. I do not see a big movement in either side.
All right, the markets have in fact opened and we are seeing a bit of a positive start for Nifty 50 and the headliners. Nifty 50 is up by about 0.05%. The trends were indicating a flattish to negative start, but we have seen a positive open. Nifty is currently hovering above the 24,600 mark. So good to see that Nifty is at least holding on to the 24,600 sort of levels. The mid cap and the small cap indices, they continue to drive the markets higher. Both indices are trading in positive territory. Small cap index as we speak is up 0.2%, while mid cap index is up 0.1%. India VIX, that has picked up slightly, but we are closer to 14 levels than we were to 15 levels. So good to see India VIX hovering below, in that 14 to 14.5 range. And speaking of sectors, some selling pressure in the banking and auto stocks. Auto stocks are down about 0.1%. Banking stocks are down 0.05% as we speak. Although the private banks, it's the private banks that are pulling the banking stocks down. But broadly speaking, trends are looking positive this morning. Some of the sectors that are driving today's market is Pharma one. It's up about 0.3%. Metal stocks are also trading higher, probably on the back of this boost and interest rate cut that we are to see in China. So a good start to the day. Nifty holding above the 24,600 mark. Sensex is also trading in the positive territory above the 81,550 levels, and this is as of 9:15 a.m. this morning. The markets have just opened. We are bringing you the latest numbers. All the sectors, as you can see on your screen, most of them are trading in the green. Banking stocks are seeing some bit of a selling pressure, and that is primarily because of the private banking stocks. They are pulling down the market. Meanwhile, oil and gas stocks are also seeing some selling pressure, and that is primarily due to this 1% rally that we saw in Brent crude. Remember, we are net importers of oil, and several of these industries are exposed. Not only it adds to inflation, but for oil marketing companies, BPCL, HPCL, in fact, Reliance also comes to mind. Or for them, it's a negative trigger. Although it's just a sentimental sort of a trigger, we should not really track one day moves to draw a broader sense or draw broader conclusions about the market. But Nishal, I'll come to you. You were saying the market needs further impetus to rally from here on. What could be that, and how should retail investors who are looking at the markets? They have rallied by about 6 to 6.5% from November low, and that run up has come quite swiftly. I think most of us were not expecting that sort of a rally. At the current juncture, what will be your advice to retail investors? How should they approach the market, in the next couple of months?
I think the best way to for retail investors is go through the mutual fund, do their SIPs more regularly, and that is what they should be doing instead of trying to go through the market directly. Avoid trading, because I think this is going to be more of a sideways movement basically, and we do not see much volatility in the market. So if you want to really do directly, basically wait for a dip, it will come, and that's a time basically to invest rather than rushing into the market now.
And Rishal, any sectors that are on your radar? Because we have seen certain sectors like IT and pharma outperform at a time when the market was falling. They have pretty much held on to the gains. But there are where, in fact, I would like to take it to you. Where do you see pockets of opportunity in a market like this?
I was telling you earlier that the government investment is going to start happening in the second half. And I think there are opportunities, both infra sector, so infra EPC players, cement, metals. These are some of the sectors basically which are going to benefit out of government's orders. We already started seeing orders coming in. There is a big railway order last week for Kavach of 10,000 crores. So I'm saying that is the size of orders which the government gives out. So I think some of the sectors, railways also could be looked at. So railways, power, infra, cement, and metals. These are, I think, 4 or 5 sectors one should focus for the next 2 quarters.
Right. Railways, infra are some of the sectors that are on the radar of Nishal Maheshwari, sectors that will see will benefit from the increased government spendings that are to come in the quarters to follow. Nishal Maheshwari, always a pleasure speaking with you, sir. Thank you for your time and thank you for the great insights.